In this module of Behind the Mission Loan, you will learn why effective underwriting is essential for Community Advantage program participants, what effective Community Advantage underwriting includes and what it does not include, and what data should be analyzed for sound CA underwriting. Effective underwriting is prudent in all lending situations, and there is no exception for underwriting for Community Advantage loans. There is additional sophistication in the CA program over the microloan program, which carries additional requirements for underwriting. The benefits of being a successful Community Advantage lender include the ability to fill market gaps and manage portfolio risk while receiving a 75 to 85% guarantee from the SBA. A lender should never approve a loan if you wouldn't approve the loan without the guarantee.
The underwriting for CA is a different ballgame, and it's important that you understand exactly what the risk is at maybe a higher level than you would review for a microloan, because we're talking about bigger dollars, and now we're talking about the government being at risk because they're putting a guarantee on this. So there are a specific set of guidelines that look a lot more like bank credit guidelines than what you might be accustomed to with micro, starting with the 5 C's. The 5 C's come into play with Community Advantage underwriting.
The 5 C's of underwriting are used by lenders to gauge the creditworthiness of potential borrowers. The system weighs 5 characteristics of the borrower and conditions of the loan, attempting to estimate the level of risk involved in extending a loan to a client.
In underwriting a Community Advantage loan, SBA still allows you to rely to a large degree on character, but that character has to be demonstrated. There has to be some history of that performance, of what has that borrower done in terms of their character. It has to be documented over a period of time.
Yeah, I may make a great brisket at home every weekend on my pit at home. That doesn't mean I can run a restaurant. And we see so many people come in with dreams that, yeah, everyone tells me I'm a great mechanic and I'm going to open up my own auto repair shop. It doesn't work that way. But there's some very specific requirements that SBA puts into the SOP that, equity injection, making sure that on a startup business, the borrower has some skin in the game, and how to document that, how to go back and look at their projections and say, okay, you give me some projections and they look very optimistic, but what are those projections based off of? Are you using reasonable assumptions? Are you looking at the market? You're looking at your competition, understanding your source of repayment, understanding, background, experience, knowledge, understanding what the market, what the industry is doing. How's it going to affect your particular business? Are you going to be involved in the business? And if you're not going to be involved, then who's going to manage your business for you? And how are they going to report to you? All those things have to be considered. So the underwriting process can be very tedious and very exacting.
So there's a lot of data that goes into underwriting a Community Advantage loan. First, what has gone on with that business up until now? What is the history? What is their cash flow? What is their historical cash flow? What does their balance sheet look like? Are they making money? And then we start looking into projections. What is their debt service coverage going to look like if we make this loan? What's their pro forma balance sheet going to look like? What kind of cash flow? What kind of debt service coverage? All of these things, including their insurance requirements, are going to go into underwriting a Community Advantage loan.
So underwriting for CA is really an in-depth approach to underwriting. We're going to look at the 5 C's of credit, and we're going to really analyze the historical financials if this is an existing business. So the whole background of the business, and then really delving into just the background of the borrower themselves. So what the business is, who are the owners of the business? Do we have guarantors? Really getting just a wide view of what this loan is. And does it make sense? Is the borrower ready to borrow money? Are they ready to start a business? Is it too soon for them? So we really have to look at it from all angles.
We always want to see the cash flow to support the repayment, whether that's coming from the business, whether that's coming from the personal guarantors, and not just banking on something that may happen in the future, something that we can actually have a history of. So business performance, personal income of the owners, and then, ideally, the business itself is going to become profitable, pay the loan on itself. But in the case that does not happen, what's our secondary fallback? Where's that cash flow coming from?
We're looking at is it a global debt service that we're looking at? Is it just based on the business? How are affiliate businesses going to affect your ability to service my debt? And how do I need to take your affiliate businesses into consideration in computing the debt service ratio on this loan? All those things are critical. We look at every one of them. We spend a lot of time in massaging those numbers and making sure we have all our questions answered to make sure we are coming up with an accurate debt service ratio, whether it's based on projections or whether it's based on historic income or historic operating results from a business. Even when you're out acquiring when someone's acquiring an existing business, does the cash flow, the revenue, does it all make sense? What you're basing your decision on? Is that business you're buying, is it profitable? Can it service the debt that you're taking on to acquire it? Does it meet our debt service requirements? Are we staying within our guidelines, our standard guidelines? Are we doing the 1.25 debt service ratio, debt service coverage on this one, and am I accepting a 1.10 on this one, and why? Support why you're doing things. Make sure you're explaining why you're doing things if you do anything outside of your normal guidelines.
And if it's a startup business, we want to really understand the projections. And that's going to come from their business plan. What do they want to do? What is their business? What is their experience? And then looking at those projections. They're not just numbers on a piece of paper, and it's very important that the customer understands that. I think it's really important to study industry averages and look at what other businesses that have been around for 3 or 5 years, what have they done? Are we in that same revenue level with this particular customer that we're looking at versus other businesses that have been out there? There's a lot of industry guidelines that we can look at. So there's ways that we can, compare what our customer puts down on a piece of paper and historical information that's out there from existing businesses. So that's where that making sense of the number comes into play. Just comparing, that compare and contrast. And then also, what the customer believes this business can do. Did they have a little startup on the side? Have they been operating this business just on a part-time basis? So they're moving it from maybe their home to a storefront, or they're expanding what they have. They need a little bit of working capital to make the business larger. So there might be some historical numbers we can look at for this business, but really it comes down to let's compare what they have versus what's out there from industry standards.
And then you have to ask that person, is that realistic? So you have to put a little bit more analysis in just industry analysis. I think that's the biggest difference between micro and the CA is just really understanding that industry, understanding what's being sold, understanding the competition, because those that loan amount is a lot higher. So you have to, again, proceed with caution.
Another important aspect of the underwriting consideration on a community advantage loan is the collateral. What kind of collateral is going to be involved in this particular loan?
You have to be careful to make sure you have good collateral, and once you start to get into more specialized collateral, inventory, there may not be a market for a certain type of widgets. So, yeah, on your balance sheet you may say it's worth $25,000, but you may only get 10 cents on a dollar. That's where you have to start to become a little bit more prudent on collateral, and sometimes it may not even be, sometimes it may not even be worth taking that car that's over 6 years old, because at the end of the day, it may not bring nothing but more servicing issues when you have to try to release it a couple of months down the line.
Another area that you're going to have to analyze is insurance. Insurance is going to become an important piece of the underwriting of a community advantage loan.
any loan amount over $50,000, number one, we're going to require that the borrowers get life insurance. That's important. It's important, especially when you have partners or whatnot, and being able to, at the end of the day, we're actually really lending to you as an individual it's just as much as we are to the business. And so life insurance is important, and just your standard business insurance, just in case, some unforeseen circumstance happen within your business, that your assets are covered.
So when we do a community advantage loan, and this is a startup specifically, or someone who's been in business for a while, but we can identify that they need technical assistance, TA. So we can bundle a TA loan, a microloan, with a community advantage loan, and then provide them with the TA that they need. So once again, identifying some of those weaknesses that the business may have or the borrower may have right off the start. So it enhances the loan. So we can do the community advantage loan, bring in a small little microloan for working capital, or to cover some of the closing costs, whatever the case may be. And then we can bring in that TA, so we can get that business services person introduced to the customer right away and start mapping out a plan of strategy to strengthen those shortcomings or weaknesses that the business might have. Because in the end, we want this business to be successful. We want to see them repay the loan naturally, but it's a good feeling when the business is successful. And after 2 or 3 years, and we're reviewing their financial statements, analyzing everything, every step along the way, TA is there with them, to make sure that they're doing everything they need to do to be successful, which in turn, keeps us focused on helping them be successful as well.
So I think we have utilized the task tool in our CRM, and at certain points when it is getting moved through our process, if it's changed, if the loan client their status is changed, for example, automatic tasks will go out, and it will notify certain people on the team to obtain certain information that we need at that point in the underwriting to move forward. So for example, with the CA program, at a certain point when they get clicked into an underwriting status, which at that point we feel pretty good that we're going to move forward with this loan, no major red flags. So when they move into the underwriting status, a task goes out to get certain SBA forms. And those are things that historically I think have they're not forgotten about because we need them in order to close the loan, but it's always kind of like, oh shoot, we should have gotten those forms sooner. And so now by having these automatic tasks that go out, we're collecting information earlier on, which allows for a quicker closing process, which has been super helpful on our end as far as deploying internally, but also for the borrower. They don't get to the point of closing and feel like it's this huge heavy lift to fill out a whole bunch of more paperwork in order to close the loan after they've gone through it can be exhaustive, I think, for some people, the underwriting process. And so, again, it helps with the customer service, I think, but also internal efficiency as well.
The underwriting portion of it, we spend a lot of time on that. Documenting everything we look at, making sure that we ask all the right questions, making sure we document our files and prepare our credit memos, identifying all those things that we looked at and why we looked at them and why we are comfortable with making this loan, why we're recommending it.
We have a 4-pronged question system we ask on every loan. The first question is, do you believe in the business? Because if we don't believe in that business, it doesn't matter if they have great cash flow with pipe dreams. What we want to do is help businesses that have the right person at the management level, they have the right background for whatever it is that they're trying to do, and we really believe in that business. So that is our first tier of underwriting, is getting on board. We believe in the business. Second, can the operating company cash flow? For many years, we often relied a lot on outside income or would over-collateralize a loan, and we, after a period of about 2 years, readdressed that and discovered that that really wasn't the right way to underwrite these loans. That wasn't helping grow this segment of our population that we wanted. So we simply look at, does the operating company cash flow? It's historical cash flow if they've been in existence, and if it's well-founded projections in a startup or a business acquisition. Once we pass that level, then we go and we look again at the SOPs. Are we crossing every T and dotting every I that's in the SOPs? If they make it past the third, then the next step is, does it meet our own guidelines? Our guidelines are crafted similar but not exact to the SBA SOP. So through this four-pronged system, it's kind of tiered. If we don't believe in the business, we stop. If the operating company can't responsibly cash flow, we stop. If it doesn't meet an SOP requirement, we stop. If it doesn't meet one of our guidelines that we deploy with reason, it's applied with reason, not, yes, no only, we would stop. If it makes it through that, we move the loan forward.
We need to simply know that you're underwriting that loan by your own written underwriting standards, that you are, in fact, adhering to those underwriting requirements that you have set out for your organization, and that you're doing that consistently.
For more best practices videos, visit the SBA Mission Lending Library. And remember, together, we're growing the economy one mission loan at a time.